The Commodities Market Bubble, Money Manager Capitalism and the Financialization of Commodities by L. Randall Wray. Policy Response. Let us assume for the moment that index speculators have helped to fuel the apparently unprecedented broad-based commodities price boom. Should policy react? If so, how? The two purposes of futures markets are risk reduction through hedging and price discovery. If we look at the second function, index speculators do not play a useful role because theirs is an allocative buy and hold strategy. They are relatively impervious to price or to bid-ask spreads. They buy commodity futures, usually indexes of futures, to achieve a diversified portfolio. Further, commodities are seen as an inflation hedge. However, to the extent that index speculators help to drive up commodity spot prices that then increase pressures on producer and consumer prices, the collective attempt to hedge against inflation actually accelerates inflation. But this hedges a different kind of risk than the risk for which these markets were initially designed. Price risk for commodity producers and users. It is true that as managed money flows into futures markets, it does increase the demand for contracts offered by producers who want to hedge price risk. Thus, the inflow is a source of market liquidity to the sales side. Against that benefit must be weighed. Against that benefit must be weighed the cost to users of the commodities, who face rising futures prices as they compete with index speculators to hedge against the risk of rising spot prices. Footnote 14. This is why Masters and White, 2008, insist that index speculators suck liquidity from markets, as they take only one side of the trades. End footnote. And of course, to the extent that index speculators cause commodity prices to rise ever upward, users of commodities cannot really win by hedging. At best, those users who do hedge are relatively better off than those who do not. Southwest Airlines is currently doing better than the carriers that did not hedge enough jet fuel. But they, too, continue to pay ever higher prices. Also worth contemplating is the end of the speculative boom. Once all managed money has achieved the desired allocation of commodities, the large volumes of inflows subside. Further purchases of futures contracts will be undertaken merely to maintain an allocation. Suddenly, the liquidity to which commodity producers had become accustomed begins to dry up. Traditional speculators revise their expectations for the course of prices. Some might begin to short commodities. A strong price reversal can take place as the market reverts to backwardation. This is what happened between mid-July, when the price of oil brushed up against $150 a barrel, and mid-August, when the per barrel price dropped below $115. As sands shift, producers who had made business plans based on price increases find that they cannot succeed in an environment of falling commodity prices. We have seen the result of a precipitous drop in agricultural commodity prices several times in the past 100 years. Of course, the most significant was during the period described in The Grapes of Wrath. The consequences for rural America and its banks can be severe. In 1935, the 1935 congressional report that introduced the Commodity Exchange Act to the House of Representatives quotes President Roosevelt regarding the necessity of restricting speculation in commodity markets. Quote, "It is my belief that exchanges for dealing in securities and commodities are necessary and of definite value to our commercial and agricultural life. Nevertheless, it should be our national policy to restrict, as far as possible, the use of these exchanges for purely speculative operations. I therefore recommend to the Congress the enactment of legislation providing for the regulation by the federal government of the operations of exchanges dealing in securities and commodities for the protection of investors, for the safeguarding of values, and, so far as it may be possible, for the elimination of unnecessary, unwise, and destructive speculation. End quote. The Act calls for controlling speculation and ensures that the exchanges function to provide a market for the physical commodities. Quote, the fundamental purpose of the measure is to ensure fair practice and honest dealing on the commodity exchanges and to provide a measure of control over those forms of speculative activity, which too often demoralize the markets to the injury of producers and consumers and the exchanges themselves. The bill has another objective, the restoration of the primary function of the exchanges, which is to furnish a market for the commodities themselves. End quote. The legislation also specifically exempts legitimate hedging from such restrictions. Quote, transactions which are shown to be bona fide hedging transactions in a commodity by holders of that commodity or of products or byproducts thereof, or by growers of that commodity, are exempt from the limits, and brokers and commission merchants are subject to the limits fixed only to the extent that they deal for their own account. End quote. Clearly, we have moved far, too far, from the intentions of Congress, financializing commodity markets with the dominant players in futures markets having no interest in the underlying physicals. The majority of the participants by volume are traditional and index speculators. While the participation of traditional speculators offers clear benefits, position limits must be carefully administered to ensure that their activities do not demoralize markets. It is, however, difficult to find any strong justification for permitting entry into these markets by index speculators operating with buy-and-hold strategies merely to diversify portfolios. It is worth recalling Keynes's famous warning, quote, speculators may do no harm as bubbles on a steady stream of enterprise, but the position is serious when enterprise becomes the bubble on a whirlpool of speculation. End quote. In his congressional testimony, Masters provides a useful analogy. Suppose there were some technological breakthroughs that led to the creation of new medical devices and drugs that could cure cancer. Further, presume that the financial wizards on Wall Street created a pharmaceutical index to provide an opportunity for investors to both diversify their portfolios, suppose health deteriorates cyclically so that pharma spending is countercyclical, and beat inflation. Pharmaceutical prices rise faster than inflation. As investors pour their money into the index fund, futures prices rise quickly, drawing in speculators, traditional and index varieties, making bets that prices will continue to climb. At some point, as the market moves into a strong contango, the drugs and devices will be purchased for inventory to hold on the expectation of rapid price increases. With much of the supply taken off the market and with demand soaring, both for use and for inventory accumulation, the costs of a possible cancer cure are driven out of the reach of patients. At the same time, rising prices would induce indices to raise their allocation targets, generating accelerating price hikes even as the funds held claims to the total supply, and more, of cancer-curing drug devices and drugs. While this might sound far-fetched, it is quite close to what happened in commodity markets recently, as the price of grains rose beyond the reach of the world's poor, as ranchers slaughtered animals they could not afford to feed, and as index funds bought contracts on larger and larger proportions of the total crop supply. If all of this isn't scary enough, imagine a scenario in which speculators were allowed to hold futures in commodified and financialized human organs, on the argument that this enhances price discovery and provides needed liquidity to the market. While it is certainly true that the rising prices of the commodified pharmaceuticals would encourage more production. The question is whether supply could grow fast enough to more than satisfy the demand of money managers able to leverage by a factor of 30 or more, in a world in which literally trillions of dollars are seeking diversification and inflation hedges. Further, just as demand for biofuels is encouraging nations to destroy rainforests and to plow the world's grasslands to satisfy the current insatiable demand of hedge funds for an inflation hedge, do we really want to divert resources to produce pharmaceuticals or organs for storage rather than to cure disease? The notion that supply and demand efficiently allocates resources through the price system is quaint and has little application to today's money manager capitalism, in which assets are purchased with leveraged money and with a view to price appreciation rather than to meeting consumption demands. No rational policymaker would allow speculators to purchase the cure to cancer only for storage in warehouses, nor should policymakers allow, much less encourage, money managers to fuel inflation, currency depreciation, hunger, and unemployment by driving commodity prices beyond the reach of consumers. The first order of business is to direct the CFTC to broaden its mission so that it can accomplish the overarching objective of the original Commodity Exchange Act, to limit the effects of speculation on commodity prices. This should include bringing more of the market under regulation by eliminating the various loopholes, including the Enron, London, and swaps loopholes. Similar rules, regulations, and oversight should be applied to all players. It is sometimes argued that this will merely force exchanges to move outside the United States, but others have pointed out that that is an empty threat. As Masters testified, any futures contract that calls for physical delivery within the United States is subject to U.S. regulation, and no person in the United States can lawfully trade in contracts that are evading U.S. regulations without specific exemptions. Further, market participants prefer liquid, high-volume futures markets. Given that the United States is the largest consumer of energy and the largest producer of food commodities, its futures markets will surely remain in demand. And no Iowa farmer is going to turn to London to hedge corn prices in an attempt to evade regulations. The CFTC must reestablish and enforce position limits. Footnote 15. Shockingly, the CFTC has taken the opposite view. Quote, in general, position limits are not needed for markets where the threat of market manipulation is non-existent or very low. End quote. This reflects the Commission's erroneous interpretation that manipulation alone, not speculation, poses a threat worthy of oversight. End footnote. In emergencies, such as euphoric boom, margin requirements for purchases should be raised. The CFTC should be directed to gather and to publish data on participants in futures markets to help distinguish among hedgers, traditional speculators, and index speculators. When the CFTC reclassified Vitol as a non-commercial participant, it withheld the firm's name. It is difficult to see why the identity of a speculator with positions equal to 10% of a futures market should be withheld from public view. Greater transparency will not only permit better policy formation, but also help to protect markets from manipulation. The CFTC must also work more closely with regulators in other countries to promote greater uniformity of practices and to avoid the tendency to rush to the lowest common denominator. To accomplish all of this, the CFTC's budget must be increased, and future funding needs to keep pace with growth of the markets. If, as this brief concludes, speculators dominate futures markets, Congress should consider the costs and benefits of allowing index speculators to pursue buy and hold strategies. Much of the managed money engaged in index speculation benefits from explicit or implicit government guarantees, such as insurance that stands behind pensions, and from tax benefits, that is, tax advantage savings. As expected, managed money is already lobbying to protect its turf, arguing that fiduciary responsibility dictates that it should assimilate diversified portfolios that are insulated from business cycles and inflation. Thus, they argue they should be permitted to retain commodities as an asset class. However, these funds must operate within constraints established by Congress to promote the public interest. If Congress should find that public interest is threatened by index speculation, then it is appropriate to prohibit commodity index replication strategies. Masters and White 2008 have argued for revision of the prudent investor rule to explicitly prohibit pension investments in commodities. Alternatively, they note that if all profits from speculation in commodities were subject to tax, it would severely reduce the attractiveness of these markets for tax advantage savings. Finally, to avoid a rapid sell-off of commodity futures contracts, they would impose liquidation-only rules on index speculators so that further purchases of commodity futures contracts would be prohibited, as the funds would gradually sell out positions. More generally, the commodities market bubble and coming crash is the third such episode in recent years that resulted from the unfettered, lemming-like herding of money seeking the highest returns, leading managed money over the cliff. To be sure, there have been many earlier examples: municipal bonds in the 1960s, commercial paper in the late 1960s, real estate investment trusts in the early 1970s, commercial real estate and leveraged buyouts in the 1980s, and so on. The problem is that managed money has grown tremendously and leverage ratios have risen, as the taste for risk grew, even as the ability to perceive risk became ever scarcer. Minsky used to attribute this in part to fading memories of the Great Depression. Many of today's money managers cannot even remember the 1980s, much less the 1930s. As a result, we have, as they say, command over too much money chasing too few good asset classes with what are perceived to be acceptable returns. This is why everything is becoming financialized, from credit card debt to subprime mortgages, and from student loans to pork belly futures. Perhaps managed money went too far when it turned America's homes, energy, and food into asset classes ripe for gambling. We should not wait for it to find the next asset class, human organs. Assuming that the commodities market boom is coming to what might be an ugly end, Congress also needs to consider what can be done to cushion the collapse. It is all too easy to say that government ought to stay away and let the market punish foolish speculators. Recent experience with the year-long credit crisis suggests this will not happen, and it probably should not be allowed to happen. Those holding futures contracts that cannot be rolled over except at catastrophic loss include our pension funds, banks, admittedly mostly foreign, and hedge funds. Further, to the extent that futures prices affect spot prices, producers of agricultural commodities will be devastated when they find that market prices won't cover the costs incurred. Tight global food supplies will be restricted further if farmers react the way they usually do to falling prices, by destroying crops and slaughtering animals. Alternative energy suppliers will be hurt by falling crude oil prices. It is already unlikely that the United States will reach its biofuels production goals even with the subsidies granted by Congress because of the high price of corn and policy-induced shortages. To help relieve distress. Congress needs to consider ramped up global food aid this year, purchasing agricultural output to help U.S. farmers facing falling prices, to be distributed to the world's hungry. American consumers need help in the form of energy relief. This can be accomplished through checks that can be called a tax rebate or a fiscal stimulus, whichever is more politically palatable. This will help to recharge the U.S. economy. American producers, especially of alternative energy, also need to be protected, temporarily, from falling commodity prices. More subsidies for wind, solar, and geothermal energy will be needed. The U.S. and global financial sector will continue to reel from the crisis that began with subprime mortgages. Falling commodity prices will only make that very much worse. Pension funds will be threatened, perhaps depleting the already shaky Pension Benefit Guaranty Corporation. The FDIC's insurance fund is facing a payout equal to nearly one-fifth of its total reserves due to the failure of just one bank, IndyMac. It is likely that many more medium-sized banks and some big ones will fail. The total could be more than 100 and will threaten the FDIC's solvency. Congress will have to walk a fine line between allowing the truly deserving to bear pain and a pragmatic bailout to keep the social costs of failures from hindering recovery. The credit crunch has already dried up lending. It could be considerably worse. Still, if a lot of wealth is not wiped out, there will be tremendous pressure on money managers to find yet another asset class ripe with possibilities for lofty returns. Without greater oversight, the cure could be worse than the disease. So bailouts will be needed, but strings must be attached in the form of regulatory constraint. It is interesting that Credit Suisse 2008 has been pushing fixed-rate swaps linked to commodities such as iron. This would put managed money into direct competition with users of natural resource commodities, skipping the intermediate step of going through futures markets. Wall Street banks have also been promoting exchange-traded funds in order to sell commodity indexes to retail investors. No matter what anyone believes about the relationship between spot and futures prices, this development makes it clear that policymakers must take the initiative to determine what should be financialized to serve as appropriate asset classes for our protected funds. Senators Joseph I. Lieberman, Susan Collins, and Maria Cantwell introduced the Bipartisan Commodity Speculation Reform Act of 2008 on July 10th to amend the Commodity Exchange Act. It would accomplish several of the objectives outlined above. It would direct the CFTC to restrict the ability of traders to escape U.S. oversight by moving to foreign exchanges and apply position limits to all food and energy-related futures and derivatives contracts, whether on exchanges or over-the-counter, exempting only bona fide hedging, Lieberman 2008. It would also prevent the CFTC from delegating responsibility for setting position limits to the exchanges, and from substituting reporting for actual speculative position limits, forcing the Commission to act more like a regulator than a cheerleader. All of this would move policy in the right direction. Unfortunately, the legislation faces a long haul through Congress and a probable veto by President Bush. Further, it does not address the bigger problem of the propensity of managed money to destabilize one market after another. The wisdom of guaranteeing and promoting the growth of managed money is an issue that needs to be addressed, but it is one that will almost certainly have to await a new administration and a new Congress.